So I would like to welcome everybody to the session on global private and public sector indebtedness, risks and policies. The session is organized by the European Central Bank. My name is Magdalena Grothe, and together with my co-organizer, Georgiadis, we work at International Policy Analysis Division of the ECB. In today's session, we have 3 papers and 2 hours, which means 40 minutes per paper. We envisage 20 minutes per paper presentation, 10 minutes per discussion, and 10 minutes for Q&A. If you have any questions during the Q&A, you can either raise your hand, and Stephen, our technician, will unmute you, or put your questions into the Q&A chat at the bottom of the screen. So the first paper is entitled Debt Crisis, Fast and Slow by Giancarlo Corsetti and Fred Maeng, both from the University of Cambridge. And with this, I give the floor to Giancarlo to present.
Thank you very much. Let me share the screen. Stop broadcast. So thank you for a program. Fred Maeng, unfortunately, is taking time off from COVID in the military service, so he could not be here presenting the paper. So it's like breaching the rule that the senior should not present the paper, but it's fine. So the motivation for this paper came from work actually done at the European Central Bank on the monetary backstop, and then at the ESM about debt sustainability analysis. So with the COVID, debt levels are rising to in regions where people believe a self-fulfilling crisis may be possible. So that is a challenge for the sustainability analysis, for the management, but especially for central banks, because on the one hand, there is this idea that monetary backstop is an important aspect of central banking, like with the OMTs in Europe, and also for the composition of the balance sheet. So the idea of this paper is to figure out whether there is a framework that is flexible enough to account for different varieties of crises. In the literature, you have Kornejew, who were inspired by Mexico, 1994. No, there was an auction of debt, nobody showed up, there was a rollover crisis. Calvo 88 was inspired by self-fulfilling inflation in Brazil that had a fiscal nature. And thinking about inflation more than a rollover crisis, you have a build-up of debt because expectation of high inflation or default in the future increases the premium on debt. Those are different kind of multiplicity, a sovereign risk crisis or a rollover crisis. Of course, they are connected. So the idea of this paper is to see whether we could have the best of both worlds. It's not only us that work on this thing. There are also Cole, for example, Guyard are working on a similar idea. Can we have a general framework that we can use for our policy analysis? So we draw on Kornejew, in turn drawing on Kornejew, but use the Calvo approach to the development of the crisis. The idea that a discretionary fiscal government takes prices in the market as given. So lenders first set the price, and then given the market condition, the fiscal authority issue that. And then we sort of use this general framework to push extensions. For example, instead of optimistic and pessimistic beliefs, a la Calvo, I'll define that in a second, we also include something else called extreme belief that allows us to mimic the rollover crisis a la Kornejew. That limit specification a la Lorenzoni-Verni, in which basically the government always push primary surplus to the maximum that is feasible economically and politically, rather than fine-tuning the global financial need. So what we gain from this approach is a model where you have lots of self-fulfilling crises of different types, So basically you have rollover crises that tend to occur, self-fulfilling rollover crises tend to occur at very low level of debt and very high level of debt. In between, you have the slow-moving hikes on self-fulfilling hikes on the debt, the interest rate on debt. So the other question we ask is, if I sit in the government, see the possibility of this crisis, is that enough for me to be scared and to try to deleverage, precautionary austerity? And the answer is actually no. It is true that only when I'm close enough to the threshold at which crises are possible, there is a strong incentive to deleverage. Otherwise, I always move consumption. I always gamble for redemption. So this is important because, with a high debt, there will be no natural welfare motivated reason to engage in precautionary reduction of debt. It will need to be assisted, possibly by European institutions. And if you think the long-term maturity is one cure for all, think again, maturity reduce vulnerability, but by no means help eliminating multiplicity. Let me just skip on the list of things. If you don't know what backstop is and you're in a central bank, you should really look at the stuff done at the ECB and this paper, the Mystery of the Printing Press that I wrote with Luca, to sort of clarify the points. Also in the Geneva report this year, we come back to this. So I don't have much time, so let me just sketch what we are doing. It's a very simple model with a benevolent government and risk-neutral lenders. Consumer are passive, so all the decisions are on the government. The framework is basically stylized. There is a state of the economy. The state of the economy is how much debt is in the morning, whether you are in a recession or in so basically how much debt, let me do this. How much debt is in the morning, whether you are in a recession or in a expansion, what is the state of the market, the belief, and then a memory indicator, whether you had defaulted in the past or not. And the realization that the fundamental risk is basically there is some business cycle risk and the risk of defaulting and losing efficiency in the economy, so it's a drop in output. So basically, this is a world where we think that in the next few years, we have a very nice road out of the current recession, but we could persist in a situation of recession also with probability 1 minus p. So the question is whether, whether we want to do something about that today, or we sort of keep borrowing against a possible future expansion. So again, the framework is very simple. Remember, it's all about a decision of the government to spend, because taxes are basically a given fraction of output. But spending is also, and this is important, there is a minimum spending that the government cannot breach and sort of drives important nonlinearity in the model. And I think it's very reasonable. So the whole point of these models is that there is a first order condition, a pricing equation, where depending on the belief of the investors, the investor choose a price, and this price is a risk-free price plus the probability of repayment. So there is basically the possibility of multiplicity there. There could be more than one price satisfying one. And if there is more than one price satisfy one, is basically an external exogenous sunspot that lead investor to choose among those. And given the price, the government chooses the primary surplus. So how does beliefs work? Optimistic investors always, if there is a possibility of lending risk-free, they do that. Always think, coordinate expectation first on the risk-free. Pessimistic, they're the opposite. Always think that there is a problem, so they always look at an equilibrium where the price is risky, there is a risk premium, and extreme actually are in the extension of the model, an agent that only lend to the government is there is no possibility of default at all, today or tomorrow. So it's a very strict condition, because it means that they only lend to governments that can withstand a rollover crisis. Okay, so let me show you how the model works, first looking at a little graphical analysis and then concluding. So remember, the default condition is basically, given the expectation of investors, tell you what is the debt tolerance, the debt tolerance threshold that the government uses to decide whether to default or not. So there is like mapping of belief into debt tolerance threshold that solve basically different kind of pricing depending on the belief of the people, whether they approach the market looking for a risk-free price solution or a risk default risky solution. So let me give you a simple Laffer curve representation in 3 minutes, like it's a little movie here. So this is how much debt the government issued today, and this is what they get from the issuance. So the price multiplied by the amount of bonds they issue. Let me start with 1 period bond just to use the graph. So you see the gross financing need of the government is basically the primary surplus plus the repayment of the old debt is endogenous because the government still chooses G. So looking at the price the investors offer to buy bonds, the government optimize G. What happens when the price goes down? There is a risk premium charge. So clearly the government will try to trim spending, but not enough, right, to reduce issuance. So the gross financing need will fall, yet issuance in equilibrium will have to be higher. You do it again, they become even more pessimistic, the same thing. They trim spending, but issuance become higher. Because remember, the higher the risk premium that the government with discount bond, the lower the price of the bond, the more you need to issue, the more you need to promise in the future to get what you need today. So in this kind of model, you have a optimal spending decision that for most of the parameter draws a downward sloping gross financing need schedule, which basically measure the smoothing, how much the government is able to optimally smooth given the preferences. The position, so it is a downward sloping because lower Q implies higher issuance, and the position of GFN depends on the initial debt. So a country with more initial debt will have a GFN going out, lower debt, the gross financing need is down. Now bring the gross financing need with the Laffer curve together in the same graph. The Laffer curve here is basically, there is a region where there is no equilibrium with fear of default, so there is risk-free pricing. And then at some point when the issuance is too large, there is a default risky pricing. Notice that the Laffer curve has a drop when the government crosses the line of entering from a no crisis zone to a crisis zone, and the slope is different. The slope is lower with risky pricing than with riskless pricing. What are these vertical lines? This is the debt tolerance threshold that depends on the mood of the investors. Remember, if I'm an optimistic investor, I first look into this region, and only if the government goes above the region, I charge a default risky price. If I'm a pessimistic investor, I first look into this region. I just want to land at the risky price, and only if the government financing need is very low, I may accept a risk to buy at the risk-free price. Notice what happened. What the belief do. What the belief do. They move the debt tolerant threshold. Right. This is debt tolerant with optimistic belief. I become pessimistic. I become less tolerant. The threshold goes down. The shape of the Phillips curve is different. Once we get this, then it's very easy to have a full equilibrium model where you have countries like, low debt country, I don't want to make names, not to use names, where basically, whether you are optimistic or pessimistic, the gross financing need is too low, to cross for at the Laffer curve at the risky price. So this equilibrium is not possible because you cannot conjecture that there will be an equilibrium of risky price if that issuance is so low that there will be no risk of default. Now you get the medium, so you get COVID, you increase your debt. You can enter this region where actually once you move from optimistic to pessimistic, this equilibrium becomes possible because given your gross financing need, if investors charge you a high interest rate, you end up issuing more debt. You end up owing more debt in the future. Issuing more debt, owing more debt in the future, basically it doesn't matter whether it's discount bond or not. The logic is exactly the same. And then you have a situation where from optimistic, once you get to pessimistic, there is basically no equilibrium there. So this is a situation where on day 8th of July, the government is issuing at 2%. On day 9th of July, there is no one buying that simply because at the conjecture risky price, people will know that there will be no space for enough contraction in the gross financing need to have an equilibrium on the Laffer curve. So there will be a rollover crisis, okay? So you see, in this case, this is what I call a fast crisis, rollover crisis, the disappearance of the market with the change in the belief of the government. This is what Lorenzoni and Berning call slow moving the crisis. It's all in calco. Basically, what happens is that you have a hike in the government borrowing cost, you start accumulating debt, you default in a recession in the future, but for the time being, there is still a market where you can issue debt at the default risky price. Okay, so this is basically a very simple graphical representation that, however, has the benefit of clarifying the variety of crises. So why is this important? Well, let me show you. So remember, the difference is that here there is default, immediate default. Nobody wants to buy the debt. Here the default is kicked down the road, right? Because you can still issue at risky prices. If you recover, you pay it back. If you don't recover, you may be in trouble. Investors know that. That's why they charge you a risky price. Now let's put it into the computer. And what you see here, that you could have a situation, those are policy functions. I have like 1 minute, so I'll do very, very quick. Policy function, you could have a situation where everything looks very nice, you are in a recession, you issue a little bit of debt for consumption smoothing. The mood changes. Here you start to accumulate debt like crazy because the cost of debt becomes very high. And here, actually, you may have a rollover crisis. Those are regions that are important. And I conclude with my most fundamental question, which is this graph I presenting, in Bonn, in Berlin, Rome, Madrid, enough to scare a forward-looking welfare maximizing politician, right? The answer is no. And the reaction is only close to the threshold in which this crisis become possible, they will do everything not to increase debt. But once you cross this threshold, they just say, forget about it. We smooth consumption, we gamble for recession. And the reason is because if you look at the welfare function, there is a cliff in loss of welfare when you cross the line. But the benefit in the future is mostly of the type of coming from the price. So it really depends on the maturity of the debt. If the maturity of the debt is very short, the pass-through interest rate is high, maybe you want to deleverage also a high level of debt. But if you have long-term debt that you can dilute investors, you don't care. So this is a situation where indeed with short-term debt, you have multiple deleverage region. But remember, with short-term debt is called comfort because short-term debt makes this threshold level much, much smaller than with long-term debt. So there is, in general, a welfare reason to have long-term maturity. I think I had exactly 20 minutes, so I should stop here. The same thing I said, extreme belief, you get Colin Keogh, where different from me, you always deleverage. You see, if you think that you can default at 40%, you really do not want to go anywhere above it. So Kornejew's result, they always the leverage. And let me stop here just showing the conclusion and before taking down the slides. Thank you for your attention.
Thank you very much. This is very, very timely. So thanks for that. And the paper will be discussed by Paola di Casola from Sveriges Riksbank. Paola?
Yes, hello. So let me share the screen. Okay, you can see the slides.
Beautiful.
No, not yet.
Yeah?
No, not yet.
Oh,
There
No.
we go.
now?
Yes.
Okay. Okay, I go. So first of all, thanks a lot to the organizers for inviting me to discuss this paper. It's very interesting. And let me just say the usual disclaimer applies since I'm from the Swedish Central Bank. These are my views and not the views of the Riksbank. So just an overview of the paper that now you've seen very well presented by Giancarlo. It's very interesting and as you understand, it's very timely. I mean, we have high debt levels following the COVID crisis. And it's well written, and especially the latest version, even more than the previous ones. And as the title says, I think the title is short and says everything in few words. It provides a unifying framework to study fast and slow debt crisis induced by investors' belief. So here I just say this that this is distinguished from the fundamental crisis a la Eaton and Gersowitz or Arellano 2008. And I say this for those of you that are used to this type of framework. Personally, I was also working more with the Arellano framework, so I just wanted to make this clarification before starting. So my comments deal with the model choice and motivation, investors' belief, and the contribution to the literature. So first of all, as was clearly explained, the paper revives Calvo's 1988 framework that was already extended in Lorenzoni Berning, and in which way? Well, it brings Calvo's timing into Conesa and Kiko 2017. And what they explain very clearly in the paper is that the major difference in the timing is the following, that with the Calvo's timing, the government can commit to a certain level of revenues from debt on and off the equilibrium path. And if you think in terms of letters, it's like they can commit to Q times B prime, adjusting both the debt and the fiscal needs depending on what prices they get in the auction, while they cannot commit to debt at face value, meaning the B prime, that will mean to adjust only the fiscal needs. This is a crucial difference from the Conesa and Kiko paper that borrows instead the timing of Cole and Kiko. So my question here is that I totally see the choice that the authors have made. I was wondering if actually the timing assumption can be more in line with the current COVID crisis and fiscal needs. So whether in this current situation, it is indeed more difficult to credibly commit to cut spending or raise taxes if bond prices at the auction turn out to be low. So my question for the authors, and in particular Giancarlo today, is whether they can link the paper even more to the current crisis as motivation for this change in the timing assumption. Okay, so now let's go to the second point of my discussion, the investors' beliefs. So as was discussed, there are three possibilities. The optimistic and pessimistic beliefs are common to the standard framework by Conesa and Kiko, but then the authors have an extension with the extreme beliefs. And then reading this description of the extreme beliefs, I was wondering whether this is extreme or these are basically default adverse, basically beliefs. And then my suggestion was to have also maybe some more figures or numerical examples. I think now there are more than in the April version, but for example, with the debt Laffer curve for this type of beliefs. And then what the authors show, this is really interesting, that the fast crises that are basically the rollover crisis are possible with pessimistic or extreme beliefs, but may happen with much lower initial debt with the latter, with the extreme beliefs. And they have a quantitative exercise showing this. While the slow-moving crisis, the slow-moving are also what Lorenzoni and Berning discuss in their paper, are possible with pessimistic beliefs. And then in the paper, they have this numerical exercise that is very useful, but the calibration is basically borrowed from Konese and Kiko 2017 that was based on South Europe during 2000-2009. So my question was whether you could do another calibration to be, I don't know, targeting some more current data, longer sample period to arrive at the recent years, or whether you have considered the so in the one part of the paper, you also study the switch of beliefs and you have a probability of switching. So I was wondering whether you have considered calibrating that probability of belief switch to match spreads, for example. And then arriving at the last point of my discussion, so there is a very nice contribution to the literature, what I call like basically generalizing and robustifying the results of previous papers. So for example, they show that the leveraging and precautionary fiscal policy is not always optimal given the threat of this low moving debt crisis, unlike what happens in Konese and Kiko, and they show more so with rollover crisis. This is a very important issue for the post-pandemic world. They also show that the results in Lorenzoni and Berni in 2019 about the long-term debt, well, actually, this long-term debt may not necessarily eliminate multiplicity. So I think this is very nice because they sort of show under which conditions those previous results found in the literature hold in their more general framework that admits two types of belief-driven debt crisis. And here my question is about the current COVID crisis. I think that especially now in the slides, Giancarlo had a very nice connection to the current debate, ECB work. I think that the paper would benefit from having stronger motivation to connect what the good work they are doing to the current issues with the COVID crisis. And for example, I was thinking since the debt accumulation of the COVID crisis happened contemporaneously to central banks' asset purchases around the world, there is a paper by Ortmans and Trige that is forthcoming in European Economic Review, showing that the announcement, for example, of the ECB's monetary policy stopped the spread of the COVID-19 pandemic to the European sovereign debt market. I was wondering whether the QE or credit easing, done by the central banks is an event that can bring a switch in investors' beliefs. And of course, this is related to Giancarlo's previous work with Luca Dedola in 2016. But I was just wondering if one could picture this asset purchases as something that moves this, that generates the switch. Because of course, in the paper, you consider the stochastic switch in investors' beliefs. And with this, I think I have 1 minute left, and I conclude by saying again that it's a very interesting and timely paper. I strongly suggest you to read it. It's very well written, especially the last version, and it offers a unified framework to study fast and slow belief-driven debt crisis. But basically, the authors generalize and clarify previous results in the literature. I think that the motivation and the relevance in relation to the COVID crisis can be strengthened, and I think some of the arguments, for example, that were discussed at the beginning of Giancarlo's presentation could be also in the paper, because I find that they strengthen the link to the current crisis. And with this, I'm done. I stop sharing.
Thank you very much, Paola. Thank you. So let me, before giving back the floor to Giancarlo, let me open the floor to questions. So if anyone would like to ask a question, please raise your hand or just type your question in the Q&A chat. No, I see no questions for now. So maybe Giancarlo, if you would like to respond.
Yeah, please feel free to interrupt. No, so let me thank you, Paola. Comments and praise, like undeserved. But she actually put down our to-do list, and she was writing on target the motivation. Remember, working around the OMTs, my problem was how can monetary policy help avoiding this self-fulfilling crisis, right? And one of the issues is that, so then you go a little bit more into monetary policy and official lending, with the ESM. And one of the problems is that there is no immaculate monetary backstop, right? There is always a little bit of risk. So, you know, you may be, the OMTs were fantastic, you know, like they work as a off equilibrium threat, credible threat for many reasons, but mostly also because they were complemented by QE. Now QE is working. Bank of England owns a lot of, for example, it's not the European Central Bank, all central banks have the same thing. Actually, there's a beautiful discussion by Trichet on this point after he left, and I'll say, oh, if only I could have done that. But the point is that this there is a risk for the central bank. So it's important for the central bank to understand the risk of intervening. So actually, I'm very open. If any of you is working on this thing, what Paola is saying is exactly what needs to be done. So a better calibration, more numbers in it. So instead of having this sharp recession and recovery, you could have bimodal distribution of output, right? So you could have more continuity. In the case, you may eliminate some multiple equilibrium, still have some multiple equilibrium in other regions. You could also get, we had a model with a political economy thing. Now you have basically alternating government where somebody is more prone to repay, somebody less prone to repay in their policy choices. That would also create this kind of equilibria there. So I think the question is very clear. Before answering the question, we wanted to have a very flexible framework to make sure that we didn't eliminate by construction possibilities or problems, not by simply not looking into them. And it's not the most general model, by the way. There is no endogeneity of output. Here we could also have endogeneity of output. That we did.
Yeah, no.
Actually, endogeneity of output, it would be fantastic. It must be somebody in the central bank work on this, because you have the issue of debt overhang, right? So it's not that you know, like letting this crisis go worsen the state of the economy in a reversible matter, right? So it's not simply multiplicity, right? That you go from one another. Once you go there, you go to a different path of the economy. There is no way back. The rate of output would be another road to go. It's too early in the morning, maybe, for the US
Okay.
for questions.
Okay, thanks for the answer.
Oh, sorry, just like another thing, sorry, just for Verni and Lorenzoni went into that limit already with something very close to COVID, right? So you're already pushing all the fiscal adjustment you can. So the debt limit framework. With Luca, we actually had a little bit of adjustment there. So it is true with COVID that we may be in the most already there, right? So the debt limit version of the model may be more appropriate. Just one of the first things you say, I forgot to mention.
But these extreme beliefs are sort of like, they don't take any default for possibility. It's like,
I mean, it is what the reason why we do extreme belief is because the mathematics becomes basically indistinguishable from Colin Keogh. So Colin Keogh is an auction in which you lose money if you participate. We don't have that, but with extreme belief, the cost, the off-equilibrium cost is exactly the same in mathematics. So we can compare the solution. And indeed, the model,
it's like to say, this is what we need to replicate that. So it's rationalizes that result in your framework, right?
So that's useful, at least quantitatively, not to see the difference. But I mean, it's very strange because remember, that model was done to rationalize Mexico, and with very low debt tolerance, but also a different. So I mean, dollar debt, right? So dollar debt, a totally different environment. Like central bank, there is not much central bank can do. While Bank of England, the ECB, the US can do a lot. No, to intervene in the market.
Yeah.
Okay, thank you very much. I see no hands raised, no questions.
Can I mention something that has been a long time conversation between Ottmar Issing and I. So I've been talking with Ottmar as a good friend and good intellectual counterparty. And he always say, the main reason why we don't like monetary backstop is that it creates too much debt in the system. So Hulig has a paper where it shows that actually indeed is the case. You have a lot of debt. The problem is that can be useful, right? I mean, think about today, the COVID thing. We walk blindfolded and happily into avoiding a catastrophe today by issuing debt. So the notion of too much debt in the system is always a welfare notion. It's never a quantitative notion. But there is an issue, which is the fact that if you make consumption smoothing more easily, you need to think of the debt overhang. So, and this is the kind of trade-off I would like to get right? So like the fact that we may want monetary fiscal policy to be able to act strongly to avoid disaster, with an issue, with an eye on how to manage once you are there, right? The containment of debt overhang. And this is where we are now. So this is why we wrote this model, because Ottmar may be right, but it's not in the model. It's not in the model. So, and I think the way to put it in the model is to get the debt overhang into action. So the fact that the higher the debt is, the more you may have reasons to discourage growth, or the more you need to be creative with all the instruments of fiscal and monetary policy you have, right? To avoid the debt overhang, which is, maybe possible, right? You can still use taxes and spending discriminatorily. But that's unfortunately what we'll have to work on for the next 10 years or 20, I'm afraid. We'll see. I stop here.
Thank you very much. Unless there are any questions, then I think we can move to the second paper. The second paper is on the supply of sovereign safe assets and global interest rates by Thiago Ferreira and Samer Shousha from Federal Reserve Board. And I give the floor to Samer to present it.
Can you hear me?
Yes, we can hear you.
And can you see my slides?
Yes, perfectly. Thank you.
Okay, that's great. Okay, thank you all for having us to present our work here. I mean, we are both from the Fed board, so the usual disclaimer applies. So this paper is related to this picture, which I guess, I mean, everyone here in the audience should be familiar with. So we can see that the real rates have been declining since the early 90s. And this kind of hints that also the neutral interest rate has also declined. So our idea is, okay, well, we will try to understand what moves the neutral interest rates. And the usual analysis focus more on savings and investment decisions, and usually doing this, I mean, in a country-specific way. So we're looking at country by country. However, if you look at this framework, it would imply that you should have similar movements in returns of different assets. And there is some recent evidence that actually the real returns of assets move differently. So returns on safe assets went down, while returns on risky assets were more or less constant during time. And also, if you do it country by country, you kind of overlook the international determination of interest rates and this, let's say, international arbitrage between different types of bonds. So what we do here is mainly we focus on the supply and demand of sovereign safe assets. And to do that, we build a new measure of supply of sovereign safe assets, which I will talk about in a minute. And here the idea is pretty simple. I mean, if you have a lower supply, you have higher prices, you have lower real yields and lower interest rates. And also, as I said, we account for global spillovers in neutral rates. So we estimate the neutral rate for 11 advanced economies since the 60s. And we simultaneously include many determinants of neutral interest rates. So what are the main takeaways of our paper? First, the supply of safe assets is important determinant of neutral rates, and explain more or less 37% of the variance of neutral rates across countries on average. And after the global financial crisis in 2008, this availability of safe assets has prevented rates to decline further. We also corroborate the global savings growth hypothesis, which is the Maeng hypothesis that the excessive savings from emerging markets pushed down interest rates since the mid-90s. So what happens here is that the lower availability of safe assets to the private sector, in our calculation, reduced neutral rates by up to 65 basis points. And finally, the global spillovers are important determinants of neutral rates. So the rest of the world productivity slowed down, and this demographic transition since the 2000 reduced the US neutral rates by 85 basis points. Also, the global spillovers help to explain the international core movement on neutral rates, and I'll talk about this more in a moment. So I'll skip this for the sake of time, but we talked to different strands of the literature. The usual papers that study the determinants of neutral rates, the papers about safe asset scarcity, and also this papers about global co-movement in neutral rates. So I'll show you a simple theory in one slide, then I'll show you how we build this measure of net supply of safe assets, and then I'll give you an overview of other determinants of neutral rates that are usually studied, and then I'll talk about the model and the results. So in just one slide, I mean, how could the safe assets supply impact the determination of neutral rates? So suppose that if we have a very simple logarithm, and this is really based on Krishnamurti and V.C. Jorgensen JPE 2012. So I mean, this is nothing new. But suppose that we have the usual utility, but I mean, the utility comes not only from consumption, but also there is some benefit from holding safe assets. And this benefit should be related to their liquidity, so it reduces transaction costs. You can use this assets as collateral for borrowing, and also some institutional arrangements related to their safety. Let's say like the portfolio shares of retirement savings, pension funds that must hold some share of their assets in treasuries and all that. Then, I mean, if you solve this simple model, what you get is that the interest rates, it depends on minus the derivative of this V, the V prime, and the V prime, I mean, it's increasing on theta, which is the supply of safe assets. So when theta is low, safe assets is scarce, interest rates go down. And when theta is high, the supply is high, the interest rate goes up. And also, I mean, we'll talk about this again when we build the measure. We think that the private sector is the marginal buyer. So we focus on the safe asset availability to the private sector. And the idea here is that the governments are more price takers, and they don't care about the price. They just want to buy some amount of reserves as insurance and all that. So I mean, the buyers that are important to the pricing are the private buyers. Okay, so what's a safe asset? I mean, it's just a simple debt instrument. So in a sense, I mean, looking at simple debt instruments and the usual US dollar dominance in global trade and monetary systems. In the baseline, we focus on US treasuries. We have an extension that looks also at German bonds, French bonds, and UK bonds. the results are more or less the same. How we build this measure of net supply of safe assets to the private sector. So we have the total gross supply of US Treasuries. We take out all the debt that doesn't go to the market. So in the case of the US, Medicare Trust Fund, Social Security Trust Fund, and all that. And also, as I said before, we take all the foreign governments' holdings of Treasury. So, I mean, to keep it simple, let's think about the foreign international reserves, but we take all the foreign holdings in US Treasury. So, international reserves, sovereign wealth funds, and everything else. And just to, I mean, because we look at a long period of time, we normalize by world GDP. So what do we get? And we can see here already how the dynamics differ a little bit. If you would look at the gross debt, you would see that it would decline until the 80s and then just keep increasing after that. When you take out what doesn't go to the market, the dynamics already is a bit different. And then when you take out also the holdings of foreign governments, you can see that there is a decline until the 80s again. It goes up until mid-80s, but then it's kind of flat, goes down, and just starts to increase again after the global financial crisis. And as you can see in this graph, until the global financial crisis, the correlation with real rates is pretty high. And then after that, actually what we will show is that, I mean, if the net supply of safe assets didn't increase that much, the real rates would be even lower due to other factors that are here, like productivity and demographics. So the other determinants that we look at is just productivity growth. I mean, several different sources, the working age population share. We also include the convenience yield. Some papers have included that before, which is mainly, I mean, the spread between very safe corporate bonds and treasuries. And then we focus on the trend of this variable just to smooth its, I mean, very high frequency fluctuations. And we also take into account, as I said, global spillovers, which I'll talk a bit more in a second. That should give you an idea on how they behave. You can see that the productivity growth was higher during the 60s. It went down, I mean, mid-70s, and then was kind of flat, and then went down again since mid-2000s. You can see also this demographic transition. So the working age population share increases until 2000 and then starts to decrease. I mean, the net safe assets we already saw before, the dynamics, and then the convenience yield, as you can see, I mean, there is a cyclical component that we smooth. But then if you look at the trend, it went up until the mid-70s, and then it went down slowly until the mid-90s, and then up again since then. So what's the model? We have a state space model with three variables: unemployment rate, inflation, and nominal interest rates, which have the cyclical component and the trend component. And we have a trend for the unemployment. We have what we call a monetary trend, which is a trend in inflation. And then we have a real rate with trend, which is the neutral rate. And then as you can see here, the nominal interest rate has loadings both on the inflation rate and on the real neutral rate. And we have many exogenous shocks, including shocks to the trends and all that. So to look specifically at the neutral interest rate, we have the change in the neutral rate depending on the change on observed trend productivity growth, the change in observed working age share, the change in the observed, that measure that I showed before, net supply of safe assets, the change in observed trend of convenience yield. And then we also put several different, we include all the productivity growth and demographic variables from other countries, and we do a kind of an aggregate using the trade shares for each country. So in this way, we can account for the global spillovers from productivity changes and demographic changes in other countries to the country that we are interested in. As I said, we have some permanent shocks and transitory shocks, and then we use more or less usual identifying assumptions. We estimate all the coefficients and all these latent variables that we have. We use a common filter to do that, and we use MCMC with 1.5 million draws. Going to the results. No, first, before that, why we think that this model is preferable compared to the others? So first, we simultaneously use many neutral rate determinants in the estimation. As I said, we have productivity, we have demographics, both were studied before in other papers, sometimes separately. We have this measure of net supply of safe assets. That's something that, we haven't seen anyone using that before. We also include the convenience tool, which has been used recently by some authors. And we have this global spillovers. And the good thing that we put everything together, and then we can account for estimation uncertainty, we can account for the relevance and all that. We use data on these long run drivers instead of just very tight identifying restrictions. For instance, some papers by Laubach-Williams and some co-authors and other papers that build up on them impose a tight relation between trend growth and neutral rates, or productivity and neutral rates. We don't impose anything. We let the data speak and check if which variable is important, which one is not. And actually, in our case, productivity will be very important also, but it's just, that's the data saying that, and not really something that we impose ex ante. The change in trend may affect also cyclical variables, so it's not just a trend cycle decomposition. And as I said, one thing that we think is very important here, that we allow for global spillovers of neutral rate determinants. So the results, first result is that we have two ways of declines in neutral rates. The first one in the 60s until mid 70s, then it goes up and then it declines again since the late 90s, 2000, and started to go up, but still at very low levels since the global financial crisis. And as you can see here, the neutral rates in our model move a lot. So we have here US, Canada, UK, and Euro area. And the correlation is pretty high. Also, what we have here is that the historical decomposition of changes in neutral rates. This is the US. We have the same thing for the other countries. And safe assets is an important driver of neutral rates. So the red bars show that, in the 60s and in the 70s, it pushed interest rates down, and then it pushed up during the 80s when you have all this, fiscal expansion and all that during the Reagan period. And then it pushed down again since the mid 90s until the global financial crisis. And now recently, after the global financial crisis, it has pushing up a lot neutral rates. And as I said, looking at the variant decompositions of changes in neutral rates, net safe assets are very important. On average, they explain 37%. Productivity is also really important, explains about 35%. The convenience yield, which is related to the safe asset scarcity, also captures about 70%, and the other ones, explain much less in the variance decomposition. But in the historical decomposition here, you can see that they are also very important. And finally, I guess I have more 3 minutes. I'll talk about two counterfactors that we do. The first one is that, okay, so now we have a model that have this all different determinants, and what would happen if instead of having this fiscal expansion since the global financial crisis, we just keep the supply of safe assets constant just before the crisis. And what we can see here is that the neutral rates actually would go down instead of going up, and the gap is pretty big. So it's about 150 basis points here in the end. So the message here is that, I mean, this increase in the supply of safe assets since the crisis, the global financial crisis, has pushed up rates and after 2008. This is a point also made by other authors like Larry Summers in a Brookings paper. But I mean, they use different types of analysis to reach similar conclusions. And another counterfactual that I would like to show you is just what would have happened if we didn't have what Bernanke called the global savings glut. And here the exercise is made, okay, instead of having this huge reserve accumulation since the mid-90s, we just keep the foreign exchange reserves constant at the 93 level. And here is the opposite, right? So, I mean, if we keep the foreign exchange rate reserves constant, what would happen is that you would have more safe assets available to the private sector. So then instead of having the interest rates down, they will be at a higher level. So this reserve accumulation pushed down neutral rates. This was the idea behind Bernanke's speeches and papers that he wrote later. And the gap here will be, I mean, in the end of the sample, about 50 basis points in our calculations. And finally, to talk a little bit about the global spillovers on neutral rates, we find that they contributed about 85 basis points for the US in this period 2000-2019. So this is the productivity slowdown and the acceleration of the demographic transition in other countries affecting the US, for instance, in Japan, in the Euro area, or the UK. Another thing that's important is that if you don't account for these global spillovers, we would give much more weight to our measure of supply of safe assets and convenience yield, because what happens is that the model wants, I mean, the data tells you that all the interest rates co-move a lot, and if you don't allow for the global spillovers, if you get these global variables to make this co-movement to happen. And then finally, we turn off all the determinants and just put one each at a time. So if you turn off all the determinants and keep only the global determinants, of course, I mean, the correlation in neutral rates will be 1. If you turn off everything and only left the local determinants, the correlation will be pretty low, 0.3. But if you just allow the global spillovers to be in place, even without the global determinants, we'll have almost a correlation of 0.8. So, I mean, this just shows that, I mean, the data screams for this global spillovers to make this, to explain the school movement in real rates in all countries. With that, I guess my time is up, so I'll leave with the discussion now. Thank you very much.
Thank you very much. And the paper will be discussed by Rana Sajedi from Bank of England. Rana, the floor is yours.
Hi, thanks. Does everyone see my screen and hear me?
Not yet.
Oh, because I haven't pressed share.
No, perfect.
Okay, great. So thanks a lot to the organizers for inviting me to discuss this paper, and thanks, Summer, for a good presentation. So I'm also from Central Bank, so I give my disclaimer as well that this is my views and not the views of the Bank of England. So it's a very, very interesting paper to read and something very close to stuff that I work on. So extra interesting for me for that reason. I'll just start by going over what I think are the contributions of the paper. So firstly, they propose effectively a new framework for estimating neutral interest rates, which allows them to estimate it for a long sample period over many countries. They then take that estimate and they decompose the drivers of the neutral interest rates, again, across many countries. Within that, because of this sort of weight on the global supply of safe assets, they calculate a new measure of the global supply of safe assets, which is kind of the one that's relevant for the model, and then they essentially empirically verify the role of the supply of safe assets that we've seen time and time again in the theory. From that, I will kind of bucket my comments in 4 categories. So firstly, you presented very briefly this theoretical framework for how why the net supply of safe assets would impact the neutral interest rate. To my mind, actually, what you propose is not consistent with your model, but not because I think the empirical model is wrong, but because I think you kind of overcomplicate what you need, and you could actually use a much more simple framework to back your empirical model, and I'll go into more detail on that. For the empirical framework, I kind of had some thoughts on how you can maybe simplify it and separate it into a 2-step estimation, which I think would be completely equivalent to what you're doing. And then once I think of your estimation as a 2-step process, I have comments on the 2 steps, which is firstly estimating the neutral interest rate and then finding the decomposition of the drivers of the neutral interest rate. And so starting with the theoretical framework and why I think it's inconsistent with your empirical model. So what you do is you put the safe asset theta into the utility function with this function nu, and you write, and this kind of came across in the presentation as well, that this is a modeling device for the benefits of safe assets related to their liquidity and safety, and you mentioned transaction costs in the presentation as well. And what that gives you is essentially a no arbitrage condition with a wedge. So the return on the safe asset, which is R, relative to other rates of return in the economy. So whether that's productivity growth or wherever the rate of return elsewhere in the economy is coming from, they're going to be equal up to this wedge, which comes from the new function in the utility function. But this, to me, is a convenience yield, right? You've come up with a wedge between the safe asset, between the return on the safe asset and other rates of return in the economy related to their liquidity and safety, and this is a convenience yield. And I think this is consistent with your explanation of a convenience yield. So when it comes to the data, you describe the convenience yield as the value investors assign to the liquidity and safety attributes of the safe asset. So to my mind, this is what nu is capturing. This is what this wedge is giving you, and so this is what you've and essentially what I think is what you've come up with is a model in which it is the convenience yield that is that depends on the supply of safe assets rather than the interest rate, which is what you wanted. And why is that? Why do I think that's inconsistent with your empirical model? Well, the convenience yield and the supply of safe assets are 2 unrelated drivers of the neutral interest rate in your empirical model, and this is the kind of standard regression assumption that different explanatory variables are unrelated to each other. Otherwise, you have a problem of simultaneity, and you're not capturing the marginal impact of each driver, right? So this is kind of the standard assumption. You write it yourself. The determinants of the neutral interest rates are unrelated to each other, which is precisely 2 of them are the convenience yield and the net supply of safe assets. Whereas in your model, these 2 things are related to each other. So the marginal impact of the net supply of safe assets comes through the convenience yield in your model. And so I think that's inconsistent. Does that mean, what does that actually mean? I think you overcomplicate things for yourself, and actually there's a much easier solution in the sense that all you really need is that the supply of safe assets impact the interest rate. And this holds in what I think is the most basic model that you can write, which is, allow agents to have access to a safe bond and productive capital. There's going to be a no arbitrage condition that says they're going to be indifferent between the asset types. that means that the private agent's optimization is going to pin down aggregate wealth, which is the sum of productive capital and supply of safe assets. And so what's going to happen in equilibrium is that the quantity of the safe asset is going to be pinned down by the supply, meaning whatever fiscal authority decides how much debt to issue, that's going to be the supply in the equilibrium. And so effectively you have that agents are going to first buy up the supply of the safe asset to ensure equilibrium for the safe asset, and then the rest is going to go into the productive capital. And so if we think about, translate that into the determination of the interest rate as the equilibrium and the supply and demand of capital, what you end up with is the x-axis is the capital to output ratio, but the supply comes from a problem that pins down aggregate wealth to income. And so an increase in the supply of safe assets shifts inwards your supply to capital, essentially crowding out the funds that are available to for productive capital. And in equilibrium, this moves along your demand curve and you increase the interest rate. And if you take this, you can add all the other unrelated drivers that you want. You don't have to create mechanisms to make them related to each other. You can add productivity, you can add demographics, you can even add a convenience yield as an exogenous wedge between the return on capital and the risk-free rate. And then what you end up with is in equilibrium, in your general equilibrium, the interest rate is going to be a function of the four drivers that you have in mind in your empirical model. And to me, this is your empirical specification. And this is, there's nothing crazy going on here. This is like a very, very simple model. If you ask me to write down a model of the determinant of the neutral interest rate, this is the one I would write down, and you get exactly the mechanism that you have in mind, and it's perfectly consistent with your empirical model. So that's my comments on your theoretical framework. On your empirical framework, I have to say I found it a little bit difficult to follow the exposition of the empirical framework in the paper and somewhat in the presentation as well. If you excuse the kind of blurry screenshots, but these are the equations that are in the paper that define your model. And one thing that I was trying to make sense of this, and one thing that really jumps out at me is that this is like two separate unrelated blocks. The first is a state space model in which you estimate your change in the neutral interest rate, lowercase r, xr. So you can estimate the change in the neutral interest rate, the path of the neutral interest rate with the state space model, and then you have an unrelated regression equation, which takes as given that estimate of the neutral interest rate and then regresses it on the potential determinants. And if you look at the numbering of the equations, you can see that I've had to kind of twist these around to separate them. In the exposition, this isn't quite how it's said, but I can't really see how these two equations feed back into the system. It really seems to me that these two equations just take the x as given, and it's these equations that estimate the x for you. So at least in terms of, in my mind, if I could separate it in, like, apologies if I'm wrong, but at least in my mind, it allowed me to separate my comments between this first step, estimation of the neutral interest rate, and then the second step of regressing it on the determinants. So on that first part of estimating the neutral interest rate, to the extent that you're proposing a new measure, I think there's some generic comments about, writing this as a contribution, comparing it to baseline, to existing measures and so on. But most importantly, I think it really highlights that you need to explain the identifying restrictions that capture your, the sign restrictions that you use to measure to identify the change in the neutral interest rate, this lowercase x. So here you had the matrix C, which is where you put the sign restrictions, and one of the shocks in Z is precisely the lowercase xr. And at the moment, there's kind of one sentence and one footnote that explains it. It took me a while to understand what it is. What you write is that an increase in the neutral interest rate contemporaneously affects neither unemployment nor inflation rates, leaving the level of the policy rate unchanged. And so if, by your state space model, if the level of the policy rate is unchanged, that means the change in the neutral interest rate gets absorbed entirely by the cyclical component of the nominal interest rate. And so it changes the cyclical components of the nominal interest rate one for one. Now, to my mind, there's some logic here, which is like a information lag or some kind of Cholesky type logic, where you're making a decision about what the central bank knows when they set their policy rates. And in particular, it seems like what you're assuming is the central banker doesn't observe the fall in the neutral interest rate, which is why they don't change the level of the policy rates following the fall in the neutral rate. And this creates a rise in the cyclical policy rate, I hat, which then creates a contractionary effect, which then, like through your state space dynamic model, will feed into unemployment, inflation over time until the point at which your dynamic model is back to stationarity, which should impose that the policy rate is equal to the neutral interest rate. And without that, it seems like I think otherwise the central bank would see the fall in the level of the neutral interest rate and decrease their policy rate 1-for-1 because they wouldn't want to create a contraction for no reason, right? If this is what you have in mind, I think you should be clearer about it. To me, that's what seems to be going on in the model. So I think you just need to be a bit clearer about that. And then the last comment on this kind of determinants of the neutral interest rate, this kind of second step, as I put it, with this, which is the regression. Again, if I just think of this as a regression, I have some kind of generic comments, show robustness as much as you can. There are other drivers that you haven't included that you could potentially include. It's not clear why you need Bayesian estimation of a simple regression and so on. But the thing I want to focus on more is the determinants that you do put in. So the two key ones that you put in are demographics and productivity. And I actually worked on a paper precisely on the effect of demographics on the neutral interest rate. So I'm just going to kind of give you some thoughts based on things I've learned writing that paper. So one thing is that your productivity measure, which is based on GDP per worker, GDP per hour, actually is going to include some effects from the of demographics via the labor supply. So you also make this point that demographics affects the labor supply, and this is going to come into your measure of productivity. And if I can take a bit more time, I can just show you a figure from that paper. So in that paper, the only driver of changes is the demographics change. So population aging, declining birth rates, and so on. Nothing else is happening. There's no TFP growth, no labor augmenting technology growth. And what we show is that we have some implied changes in the output per worker or output per hour. Just is Michael going to tell me?
Maybe 1 minute left.
Okay, but yeah, I think that's more than fine. And we get some fluctuations in what would be measured growth in output per hour or output per worker, driven entirely by the demographics. And actually, if you kind of, if you squint, as one of my co-authors would always say, if you squint, it actually kind of looks like the path that you described for your productivity growth, high in the 60s, low in the 70s, declining since the mid 2000s. And so it's just to make the point that there's some impact of demographics in your productivity measure. To me, that's fine. That's actually fine, because what you want, what we also show in that paper is that the main effect of demographics comes through the increase in retirement, and the fact that retirees tend to be high wealth, and so they really push down on the neutral interest rate. And so for that, what you really should be using is the old age dependency ratio as your main demographic indicator. And I've seen some empirical papers that kind of corroborate that as well. So I would really encourage you to use that. And then in like 30 seconds, the very last comment I had is about this global spillovers versus the co-movement of drivers across countries. To be honest, it wasn't really clear to me why this distinction matters. I agree that the global spillovers is important and we shouldn't just think of these as locally determined, but I don't understand why I should care about global spillovers versus the co-movement of drivers. Ultimately, if you think about a global neutral rate, it's global averages that matter. And there's a specific way of thinking about the importance of domestic factors over and above the global neutral rate. And actually, going back to my first comment, I think this is where I would have really used, could have really used a theoretical framework to help me understand what is it that you have in mind? Why does it matter if it's the fact that my productivity is moving with the global average, or it's a global average that's spilling over to my economy? I couldn't quite figure that out. But that's all my comments, and thanks again for the opportunity to discuss this paper.
Thank you very much. And let's collect some other questions. I saw Paola has a question. Paola?
Yes, hello. Yeah, I wrote it here. So my question was about the decomposition, the table you show with each country. So I was expecting, especially because I work on Swedish data, and we always think that the economy is small, very open, financial market is super open. I was expecting a large role of global factors. In the end, productivity is like covering more than 50% of the share, and similar for New Zealand. It is also a small economy, very open. So I wonder if it's because productivity is also global, or there is something that I missed in how to think about these domestic versus global factors. Thanks.
Good morning, Paola. This is Thiago. I can take your question. So no, the key issue there is like we're doing the variance decomposition, right? So if you think about the variance decomposition, that's going to depend on two things. It's going to depend on the variance of the driver. In this case, let's say the variability over time of the driver, meaning really just the variance. If that thing varies a whole lot, that has a lot of variance, right? The second thing that would depend is on the beta, or on the coefficient, or how much the neutral rate loads on that determinant. So if the beta, if the coefficient is really small, like 0, it doesn't really matter whether productivity is super variable or not, right? For instance. But what it turns out is that for those countries, productivity, the variance of productivity is actually quite high, and the coefficient, or the loading on productivity is also, I'm not going to say high, but it's a reasonably it's a reasonable coefficient. So once you put these two things together, then we get like a variance decomposition, or an accounting in which productivity has a good deal of explanation for those countries.
Thank you very much. If anyone has a question, please raise your hand and we'll be able to unmute you. Otherwise, Samer, would you like to respond
Sure.
to this question?
Yeah, so thank you very much for the very nice and thoughtful discussion. So for the first point, which is related to the theoretical framework, it's true that in that model, what happens is that the supply of safe assets enter as moving the convenience yield, and in a sense, I mean, in a way, it would make them related. So in that model, which is very simple, the convenience yield is kind of a channel through which the supply of safe assets affect real rates. So what we really wanted here is that there are other things that also affect the convenience yield, which is not the supply of safe assets. So we include both in our state space model, really to control for this other determinant. Let's say some regulation that you have. I mean, some financial institutions have to hold more safe assets since the global financial crisis. This is not in our model, and this also affects the convenience yield. So we put both here. In a previous version of the paper, to control for what Asha was worried about, we orthogonalized the convenience yield in the supply of safe assets, so to make sure that they were unrelated, and the results were pretty much the same. I mean, in this version we don't do that, but in the previous versions we did that, and the results were pretty much the same. For the second comment,
Samer, do you mind if I just say one thing on this
Sure.
first point on the model? So I guess another way to think about this is if you get our equation, right, and let's say you log linearize it, depending on, let's say, the first principles, because the convenience yield is not a first principle. It's not like the primitive, right? But if you then let's say log linearize and make it dependent only on the first principles, what you're gonna get is that you're gonna get rid of the convenience yield, and what's gonna show up is the supply of safe assets, and let's say any other things that move the convenience yield, right? So while your point is, I think you do have a great point, like that we could model in a different way. We still think that this is one way that we could model, and we can motivate well why the supply of safe assets should matter for the determination of neutral rates. But yeah, thanks a lot.
And then moving to the second point, if we have time yet. It's not really a two-step approach because we estimate everything together. So in a sense, it's kind of taking that equation that you separate it down and pull it in the complete model. So everything, I mean, it's done at the same time. I understand your point that in principle, because these things are exogenous, we could just, I mean, do it separately. But what we wanted here also, I mean, is do a full estimation of the model. So I guess, I mean, it wouldn't change that much the results in that, but we will add more. I mean, let's say estimation error if we do it in this way that you were thinking. That's my impression. But I mean, it's a more technical thing, so we could discuss it later. I think that the other points that you have in the identification restrictions, you're right. So in a sense, what we are saying is that, I mean, in the very short run, the central bank is not observing, for instance, the movement in the neutral rate. So they kind of neutralize this movement in a sense. So the identifying because we don't do really, I mean, impulse responses and all that. So the identifying restrictions here is not also, I mean, something that, I mean, they are important, but the most important thing there is that, I mean, we use kind of very usual and agnostic identifying restrictions is really because, I mean, it's not our main point there. That's the key thing. We are looking more at the medium term movements and all that. And
I think we should slowly wrap up. So
okay, so very quickly on what you said about the other determinants. This is a point that, I mean, it's true. I mean, so this relation between the productivity and demographics, I mean, I saw the people making this point before. So really, I mean, we didn't want to go in this direction of, I mean, if they are related or not. The idea is just including other controls, and our main focus is the supply of safe assets and the safe asset market. So it's not really on these other determinants. The other determinants are there just to control for other things that also could move the neutral rate. In the limit, what it could be is that we have the supply, and then this productivity, demographics, and the convenience yield are kind of capturing demand, which we don't have here. So, for instance, in demographics, it's pretty clear, as you said. If you are in retiring or close to retirement, you would like more safe assets than risky assets. So then your demand, if you start aging, the demand for safe assets would increase. So in a sense, we're trying to capture this demand factors with this web. It's another way to look at the same model. But I guess we should wrap up, and thank you very much for all the comments.
Thank you very much. So let's now move to the topic of private sector indebtedness. And we have the third paper, Zombies at Large, Corporate Debt Overhang and the Macroeconomy by Òscar, Jordà, Martin, Kornejew, Moritz, Schularick, and Alan Taylor. And Martin, I give you the floor.
Many thanks, Magdalena. And let me also thank the conference organizers for putting our paper in this exciting session. And I'm personally delighted to present what Òscar, Moritz, and Alan have been working on. And we are very much looking forward to your comments, and especially those of Ryan later on. And I should also point out the disclaimer, I guess, that this does not represent anything that the federal system, reserve system thinks. Okay, let me also enlarge, actually. Okay, so what got us...
We can see the slides, Martin.
Oh, sorry. At least I unmuted myself. No, now you should be able to see it.
Now it's perfect, thank you.
Thank you. So what got us working on the topic was that risk that business debt may pose to the macroeconomy as a whole is still imperfectly understood, and continues to concern policymakers and the private sector. And as you perhaps can infer from the dates of these headlines, this is especially true recently for the US, but also in other countries, where we saw a boom in business credit to GDP, ironically kind of in the run-up to a global pandemic that would wipe out sales, disrupt supply chains, disrupt labor markets, necessitate additional credit to help struggling corporates, and potentially even would undermine some business models in the long run. So the question is, to what extent is this pile of corporate debt a problem for the recovery out of the recession and potentially even for growth going forward? And this is to ask more specifically whether corporate debt overhang will restrain aggregate investment on the one hand, and on the other hand, whether the kind of entrenched credit relationship that have emerged between banks and businesses, whether they may kind of incentivize inefficient evergreening of loans to so-called zombie firms. And what we have in the back of our mind is, of course, the role of household debt in the post-2008 recovery. But let me be first, before getting to results, let me be very clear about what we think how corporate debt may affect growth. So a recession raises the baseline default risk, and the more businesses are leveraged, the more severe the effect becomes. And then we get the classical Myers debt overhang under investment problem, because firm owners, when taking their marginal investment decision, do not internalize the gains that would accrue in the state of default to the creditors. And this may lead them to reject projects even if they have a net positive net present value. And despite of several theoretical qualifications to that result, there's a long chain of empirical studies that found evidence of debt overhang related underinvestment and subdued firm growth at the micro level. The question here is, of course, can we extrapolate this to the macro level right away? Because ex ante, we would expect effects to be a little bit muted. So whenever a firm is constrained by that overhang, this will leave room for their competitors to grow in turn. And moreover, the micro evidence is typically stronger for smaller firms. However, for example, recently in the US, they make up 80% of the firm population, but only account for 20% of the overall business debt. So this is important for macro results, of course, too. And in principle, independent of that, but of course related, is that business indebtedness not only increases default risk, but also increases exposure of financial intermediaries to those possibly defaulting businesses. And especially the weak banks with shaky balance sheets may choose to rather channel credit to near bankrupt borrowers in order to not incur losses, at least now, because perhaps their capital buffers are already under strain. And if this happens on a large scale, this may be a threat to business dynamism, creative destruction, and eventually productivity growth going forward. And the final piece that we distill out of the current literature is that bankruptcy institutions may play an important role in modulating these two aforementioned problems. Because in principle, debt renegotiation could fully resolve that overhang, while the zombie problems would certainly be aggravated if creditor rights are weakly enforced or lengthy business bankruptcy procedures delay the returns from those liquidations. So the large heterogeneity that we see in business bankruptcy institution quality across countries and also across time within countries may be an important factor to consider when evaluating these macro effects. So what do we do with all of that? We turn attention to macro-historical data to try to discern whether recession severity can be predicted or just put it correlates with the size of the preceding business debt boom. So are recessions deeper when there was a credit or corporate debt buildup in the years before, or has the recovery been slower? And we will benchmark this by a similar sized household debt boom to get a sense for the magnitudes. And in order to operationalize all this, we need to get new data for business debt. And in the last step, we also augment this by legal indicators in order to try to get to these institutional effects that I mentioned. And surprisingly, we find very little, if any, evidence that business debt boom predict worse recessions or slower recoveries. But this seems to be a reflection, at least this is our hypothesis, this seems to be a reflection of efficient debt resolution on the business side, because when a business debt boom hits weak bankruptcy institutions, we do indeed see considerable economic cost showing up. Okay, so a little bit more on the data. The long run business sector debt liabilities is on annual frequency and comprises not only bank loans but also bond market debt and lending from non-bank intermediaries, and covers 18 countries, of course, with gaps pre-World War II. And this is then matched to the macro-financial data from the macro history database. And we use, just in order to, we will focus on recessions only. So in order to date the business cycle, we identify local maxima in the real GDP series and call this a business cycle peak, and whatever follows a recession by definition. And finally, we use the widely cited series from secondary literature or from the World Bank in order to measure a bankruptcy quality. And this is a panorama of our kind of data centerpiece. So this is business credit relative to GDP from over the whole kind of time span that we cover. And I think 3 points stand out. The first one being that pre-World War II, there was much more heterogeneity across countries and how indebted their business sectors were relative to the size of the economy. And then following the Great Depression, we have kind of a collapse in business debt across all countries, more or less, and a steady rebuild up after World War II. That is, business credit outgrowing GDP for more than half a century, and now reaching record highs in many cases. And this is to build intuition for whatever follows. This whatever I will show you today will be more kind of statistically more sophisticated variation of these very simple plots. And they show every cross shows a country year with a business cycle peak, and on the x-axis you see the size of the preceding business credit boom on the left-hand side or household credit boom on the right-hand side, and on the y-axis you see the depth of the recession measured by GDP 2 years ahead. And while there's seemingly no relation for business credit, we see this already well documented in the literature negative relation or correlation in this case between household credit and real GDP. So now we'll try to do this a little bit more rigorously, and let me introduce the notation. So as I said, again, we focus on the country year sets or sample of business cycle peaks. Our main dependent variable will be the change in real GDP from T to T plus H, thus measuring or approximating the cumulative growth between these two time periods. And our main explanatory variables on the right-hand side will be 5-year changes in credit to GDP ratios, business credit, of course, and for our benchmarking exercise, household credit. So this is measuring the speed or how fast credit was outgrowing GDPs in the years, the 5 years preceding or coming up to the business cycle peak. And this will be then related to the cumulative recession trajectory going forward. And we control for various macro financial controls I'm happy to go into details later if you're interested. We run a set of local projections, pretty standard actually. So on the left-hand side, we have GDP. We will guess this on country fixed effects, our two main credit boom measures and controls. And what I'll show you now is the average recession path. So when all regressors are at their country-specific average values, see what kind of the average prediction for a recession trajectory is. And then we will kind of switch on a 2 standard deviation business credit boom and a 2 standard deviation household credit boom subsequently to see how the recession trajectory is shifted. So as I mentioned, this is the average recession path. So in year 0, we have the recession, we have the business cycle peak normalized to 0, and then changes in percent from there on. So we have the recession and then the gradual recovery. When we have a 2 standard deviation household credit boom, we find this already well documented negative effect. So we have a much deeper recession lasting 2 years in this setup, then GDP lingering around a bit before picking up again. But doing the same exercise, again, switching household credit back to 0 or to average, and switching on business credit growth, we see no effect, or at least no statistically significant effect for the average prediction, which was the first, which was surprising to us. So we dug a bit deeper. So first of all, we changed the dependent variable, where we see kind of the familiar, I would say, general equilibrium story showing up for reconsumption, investment, unemployment, inflation. So we see that household credit does have negative effects on consumption, investment, positive effects on unemployment, and does subdue kind of inflation a little bit, but nothing of any similar kind for business credit. We can also go into the pictures later. Just because of time, let me move on here. We'll also conduct several robustness checks, and please let me know if kind of your favorite robustness check is not included here. And then we also distinguish by recession type. So does the effect of business credit perhaps only show up when also the financial sector is in trouble? But if you look here at the dotted path, which shows you the average financial recession path with a business credit preceding business credit boom on the left and a household credit boom on the right, the same story seems to go through. And finally, is it perhaps about different moments of the distribution? So far, this was all about averages. Perhaps it is the left tail that moves when the business are indebted. But again, similar picture here with these quantile local projections. So naturally, the question is, what is the difference then? How can it be? And of course, there are lots of differences, obviously, between household credit and business credit. But the one that we would like to highlight here is the legal status. So debt to businesses is debt to a kind of abstract legal construct. And these debts are limited ultimately by business assets. This is not the case for households, which is owed by natural persons. And we don't have kind of the leveraging upon unemployment, at least not automatically. Going to this point, the fact that assets limit liabilities, the underinvestment only makes the underinvestment problem possible, and this provides the incentives for creditors to restructure, and we have no similar mechanism for households. And finally, businesses can be liquidated, but households, at least, so unfortunately, not any longer. There are some parts in the world, but not on our sample of advanced economies. So if this is true and this is important, we should be able to see whether inefficient bankruptcy regimes squander these advantages of business debt. So in particular, we think that frictions to renegotiation would make kind of the debt overhang problem show up again. If the theory is true that renegotiation limits debt overhang, frictions make it show up again. And similar, more or less efficient liquidations should augment the zombie problem. So the zombie problem is more of a supply problem, so it's not, we'll never kind of go completely away with very efficient institutions, but weak institutions should aggravate it. And then we use these two data sources in order to measure bankruptcies. Since I'm a bit low on time, let me go a bit quicker. So we only cover a modern sample here. This is important to know, to note. And the first one is about creditor rights, which is related both to liquidation and renegotiation. And the second source from the World Bank, we take the recovery rate, so the cents on the dollar of secured debt that are recovered in case of financial distress. And again, higher recovery rate should indicate lower cost or more efficient liquidation and swifter restructuring. And we combine these by projecting these two measures in their deciles and have then a combined 10-step indicator that we can apply to our set of 18 countries across these 40 years of data almost. So we simply include an additional term in our familiar local projection that interacts the business debt boom with this measure of legal efficiency and see whether this does anything to the predictions that we get out of a business debt boom. So what I plot here is, again, a 2 standard deviation business credit to GDP boom in the run-up to a recession, and then see whether, depending on whether bankruptcy institutions are efficient or inefficient, the predictions for the recession trajectories differ. So in blue, we have low-cost bankruptcy regimes or low-friction bankruptcy regimes. We don't see any significant difference between the average trajectory and the one after a business credit boom. And in purple, we see the effect or the prediction for a bankruptcy regime that is, that features lots of frictions by these two measures. And finally, we also kind of supply a causal element here, exploiting that legal origins are arguably exogenous to today's business cycle shocks, and exploiting that civil laws or civil law systems feature frequent interlocutory appeals and during bankruptcy proceedings that impede restructuring and liquidation. And indeed, just taking this as a 0-1 dummy, switching to 1 whenever we are in a country with a civil law legal origin, we see a strong negative link to bankruptcy efficiency in the first stage. So then proceeding naturally with 2-stage least squares in our sequence of LB regressions, we confirm what we just saw, that bankruptcy regime efficiency seems to be an important modulator of the effects of business debt booms. And let me conclude here. So we find scant evidence of the predictive power for recession trajectories and point to the legal differences. And that in the case of business debt, legal frictions seem to have a very important role, which carries obvious policy implications. And thank you very much for your attention so far.
Thank you very much. And the paper will be discussed by Ryan Banerjee from Bank of International Settlements. Ryan, please.
Thanks, Mike. Okay, can you all see my slides?
Yes, very well.
Very good. So, so thank you, Martin, for that very clear presentation. So let me start my discussion by thanking the organizers for getting me to read this paper. It's been on my reading list for a while. I hadn't read it carefully, and doing the discussion made me read it more carefully, which has been a very big help for me, actually. I learned a lot from it. So super topical topic. I'm going to jazz it up a bit in terms of how topical it is by dipping into this little excerpt from Torsten Slok's oops, I suppose I'm writing wrong. Torsten Slok newsletter on the 5th of December last year, and he said there's an important debate at the moment about the role of zombie firms. The BIS has argued that the rising share of zombie firms in the economy is holding back growth. And see, for example, these are some of my papers here. And then yesterday, the Fed released a new paper. This is the paper we just heard now, saying that zombie firms are not a macro problem. And this paper, this potentially from this email from Thorsten Slock, certainly got a lot of attention in policy circles, and policymakers are certainly wondering whether they don't have to worry so much about the post-COVID corporate debt boom in light of the results of this paper. So let me summarize this paper in one slide. It's 3 results. Firstly, recessions preceded by stronger corporate debt booms are not deeper, unlike those preceded by household debt booms, shown by previous work by some of the co-authors. Then they focus on the deepest recessions, as within their quantile regression framework, and show there's also no relationship between stronger or the deeper recessions and stronger corporate debt booms. So we're sort of focusing on those deepest recessions in the quantile framework. However, there is a relationship between the recession depth and stronger corporate debt booms after conditioning on the efficiency of insolvency regimes. So does it mean that there's no need to worry about corporate credit growth if insolvency regimes are efficient? And so I'm going to try and I'm going to go through these 3 points, not in that order, in my discussion. So the first one is it's about relating the paper to zombies. So this paper is about corporate debt booms and recessions. And a great piece of marketing is if you put zombies in your title, you're going to get more attention. But I'm going to see if there is a link between what the corporate debt booms in this paper and are they zombies. Unfortunately, to get there, I've got a little bit of a roundabout way of getting there because there are some caveats here in going through it. Firstly, I'm going to show you how to replicate the results in this paper, but using a slightly less good set of data, which either the Jordà Schularick data macro history database or the BIS total credit data. They have pluses and minuses, but they're not as complete as the data showed in this paper. I'm going to then ask the question, this paper focuses on recessions, but there's a question of zombies in general and their effect on growth and corporate debt booms. Then I'm going to ask the question, this is what I really wanted to ask in this point, was are zombies at all related to corporate credit growth? And finally, is the credit-driven rise in zombies actually having an impact on GDP growth? So for transparency, here's the data I'm using. I use 2 sets. I use the JST macro history data set, which looks like this, starts from 18 something or other, ends in some point in the 2017. I'm also going to be using the BIS total credit data. It has less coverage, starts with reasonable coverage in 1960, but it covers not only bank debt, it covers bond debt and some other things as well. So just for transparency, the data used by that Martin just presented is actually slightly more complete than both of these in various dimensions. So the first thing I'm just going to do is I'm going to replicate with this less good data the results of the paper, which is basically using the JST data. You get the result that when you look at recessions only, or this post-recession growth and the pre-recession debt booms, that household credit matters, corporate credit doesn't. Now the same thing holds when I use the BIS sample, BIS data, using all this data in that sample. The same. Slightly less significance. This is at the this means significance at a 10% level. I know Alan doesn't like having 1 star for 10% significance. He likes the plus, and so I decided to use that. Now let's just put the JST data on the BIS sample. It still holds, and because of the final part of the paper is based on the post-78 data, I wanted to just double check that the result held there, and it does. So basically, the story is that stronger credit rise in the 5 years before a recession does not predict a deeper recession, but household credit growth does. But then I looked at the back of the paper and it shows the business cycle peak dates. And for Japan, the business cycle peak date is in 1997. So let me just show you what this means for what the paper is doing. So the business cycle peak is the point of division between the red area and the blue area. And so the data in this paper is using the following. It is using this part as the GDP growth data, as a GDP outcome data after the business cycle peak, and it's using this part here as the data for the pre-business cycle credit growth, the pre-business cycle peak credit growth. And what this black line here is plotting Japanese non-financial credit to GDP, and you can see that during the period in the sample of the paper, actually credit growth is actually falling relative to GDP. And so, and if you look, this is the lost decade here, I highlight the lost decade, you see this paper is kind of missing a lot of the lost decade that, you know, that's most of the sample in Caballero, Hoshi, Kashyap's famous paper. Now, what does that mean for zombies in Japan? So this is based on work that I've done with my colleague Boris Hoffman about measuring the zombies based on across 14 advanced economies, using publicly listed companies' data. And this is the zombie share that we compute for Japan. And what you can see is that the zombie problem starts quite some time before the sort of the weak GDP growth period in the paper. And so let's use all the data. That was my thought. You know, why focus on just this post-recession point? Let's use all the data, but I'm going to still use the convention in the paper. We're going to look at GDP growth in T to T+2, and these are going to be credit growth, household and corporate credit growth from T-5 to T. Well, hang about, isn't that just what Mian, Sufi, and Werner did in their QJE paper, which actually used the JST data? And here I replicate their result, that indeed household credit growth is stronger household credit growth is correlated with weaker GDP growth, but not necessarily for corporates. But then I sort of, since I had the BIS data on my computer, I just ran the same regression again, and then something's a little bit different here. So when you use the BIS data, which has refinements in slightly better information about corporate debt, but also a more restricted sample, you find that both household credit and corporate credit growth seem to matter for the subsequent growth thereafter. Now, one easy thing to see whether it's the sample or the coverage is just to use the JST data on the BIS sample, and it's still there. In fact, actually, the household credit growth disappears. Then, because we looked at post-78, it's still there. And so I did just some quick data hacking to see, you know, what is it? Which part of the sample period seems to be driving the difference, you know, causing the difference between this result and this result? And it's basically something happening in this post-war boom era, where once you take it out, you exclude 48 to 70 or 55 to 70, you can choose a few times. You kind of lose the fact that household credit growth matters, and you find that corporate credit growth does matter for subsequent GDP growth in the next 2 years. You know, is this related to something? There were good credit boom years in that era, I'm not sure, but it's probably worth investigating. But just a simple plot gives you some sort of eyeball, sort of a sense of what's going on. During so the red stuff is all pre-World War II and post-70 data. The blue stuff is this post-war boom era, and you see that when GDP growth was higher when credit growth was higher in the 5 years before the date measured, GDP growth is weaker with the red stuff, but it's the opposite sign with the blue, with this post-war boom period. So it's kind of worth thinking is that we can use more data, but if the regime is different and something is different, so we know that credit was quite tight for corporates in this era, and my own work has been thinking about how the tightness of credit mattered for the quality of the allocation, and particularly interest rates. You start to wonder whether the strong results from the JKST paper that Martin presented is, you know, how relevant they are for what we're thinking about today. So let's get to the point that I really wanted to make with this, which is why I went this long way to get here, which was, does credit growth predict more zombies? And basically the answer is yes. So here I've got the zombie share from some of the work that I've done with Boris, from T to T+2, so the same era, same period as the GDP part. And you can sort of see, particularly when we use all the data rather than just focusing on recessions only, that stronger corporate credent growth is positively correlated with more zombies in the following two years. And, you know, there's no relationship with household credit growth. But note again, this is why I wanted to do all that stuff before about the sample period, is that our zombie measure is only from 85 to 27. So we missed a lot of the history to really be able to be conclusive about it. Now, the final point, the final observation then I thought was, Well, so credit creates more zombies. Now, do those zombies then result in weaker credit, weaker GDP growth? Now, the problem is you can have some reverse causalities. GDP growth weakens, and what we measure as zombies really increases, but it's reverse causality. So what I did here is I instrumented the change in our zombie share in this T+2 with the change in debt to GDP growth in this preceding period, and also the change in the zombie share in that preceding period. And what do we find? Is that we find that when there are more zombies, indeed, when there's stronger credit growth leads to more zombies, which then leads to weaker GDP growth, at least in the sample period. And so I think maybe a bit too early to say that we shouldn't worry too much about zombies. And maybe we're also capturing some part of the idea of the regime here. So my second major point is thinking about the insolvency regimes and going a little bit further. Insolvency regimes, okay, and recession debt. Okay, so I'm going to make one very simple point here is that, is there something about, is it just insolvency regimes? Is it insolvency regimes and weak banks? Or is it something more, which is Alan Greenspan's spare tire? So Alan Greenspan brought this idea of the spare tire, which is the ability of the capital market to act as a spare tire when banks are distressed. And some of my colleagues have also found that when you have more market-oriented economies, the impact of a financial crisis is a bit weaker, because you can always go, the banks are in trouble, but the good corporates can always go to the capital markets. So here, this is going to be based on some work that I was secretary of a report chaired by Viral Acharya when he was at the Reserve Bank of India, and Lee Boat when he was at the People's Bank of China on establishing viable capital markets. And what we found is that the size of your capital market, this is actually the bond market, is positively correlated with the recovery rate. There's also significant differences in the importance of bond markets over history, over time in different countries, as we split them up in some other work into two groups. And you can see this is like the US, the UK, and some Anglo-Saxon countries. They've always had about 50, the ones that were in Martin's work was probably had the most efficient insolvency regimes, also had the largest reliance on capital market finance compared to bank lending. So my final point here I'm going to make then is are inefficient insolvency regimes a sufficient condition to avoid debt overhangs weighing on growth, or just a necessary one? And I think this really matters thinking about the post-COVID recovery, because it may be easier to change the law to make your insolvency regimes more efficient. It's a lot harder to then have put the infrastructure in to have a liquid capital market. And so I think there may be maybe worth thinking about when I'm thinking about the results we just saw. I had one very small point about the quantile regressions here to publicize my homework on inflation and risk. But basically, it'd be nice to see some graphs like these to understand what's going on between the OLS and the quantiles to help interpret what's going on in the results. So, by conclusion, extremely interesting and topical paper, raises super important issues, particularly at the current juncture. What's not so obvious in the paper is they've done a lot of work enhancing the data set. It's a fantastic public good. Now, the question is, will zombie firms be a macro problem post-COVID? I think there are many elements to consider. There's not only the recessions, which is what this paper looks at, but also the role of zombies in the recovery phase, which I sort of showed if you used all the data, tells a slightly different picture. And finally, is it bank health or alternative funding sources are also important in interpreting the final result in the paper, as well as just the insolvency regime itself. I'll stop here.
Thank you very much. I see no raised hands, but we also are approaching the end of our session. Let me maybe add one very small question, if I still may, before giving the floor to Martin to respond. I was wondering whether you maybe considered also the interaction between household and business credit booms, whether these effects reinforce each other, and also whether maybe you considered controlling for fiscal expansions. And the reason I ask is that during the last year, we have observed a synchronized expansion in the credit across sectors. And I leave to you, Martin, to respond.
Yes, thank you very much, Ryan, for all the data work. That was very, very insightful, actually. So regarding this post-war recovery phase, that's an interesting point. We'll look into this. The question that I had in mind is, so could you pin down already right now, or what would your gut feeling about what it is that makes the relation so different back then? I mean, we also try to interact booms with levels. So for sure, as we saw in the panorama graph, business debt levels were just much lower relative to GDP, but this didn't explain the. So this cannot be the explanation, because there we don't see any interaction effect that seems relevant. But certainly there are lots of other things that are important. Perhaps it's also the Bretton Woods period with capital controls that matters. We'll look into this. Then let me clarify that that I think, so my personal take is not at all that we say that zombies don't matter. Also, zombies are just one part of the story. So I think if we see any effects, the major effect should come from that overhang, and zombies are just kind of a footnote to that. It's always just kind of in the background, and yeah, if we see effects through the bankruptcy with the bankruptcy interaction, this perhaps kind of plays on the zombie part. But yeah, I don't think that we would like to have this paper understood as saying no, zombies are not a problem, just forget about them. Then on the capital markets, that's also something that we had on our to-do list, but not yet not even started really yet. Do you think it is the bond market which we kind of try to gather data on it and see whether it matters whether the boom is in bond markets or in bank lending? Or do you think the capital markets that help to resolve kind of corporate debt crisis are rather the secondary market for non-performing loans, which may be deeper also and kind of correlating with bond market development? So yeah, we are trying to look into this, but that's for sure nice to point out that this may correlate with bankruptcy efficiency. Regarding one small note on Japan 1997, so we vary around the length for measuring corporate debt booms. We take 3 years, we take 10 years, we take a difference in logs and so on. And kind of this robustness check with 10 years should cover also kind of, for example, this specific example that you had about Japan. So this seems pretty, this is remarkably robust. But yeah, it's of course, when we have just one regression for 150 years, this will always be a little bit of frictions involved. And regarding the questions of Magdalena, at some point, I think we tried interactions of household and business credit. At the same point when we also looked into the interaction between levels and booms, and we didn't find much that was interesting. Otherwise, we would have put it in the paper for sure. But we did not explicitly consider fiscal expansions or I mean, do you think about fiscal kind of expansionary fiscal policy, or do you think about government debt? I think government debt was on our to-do list at some point, and we did it, but not explicitly expansionary fiscal policy. Yes. So also notice taken. Thank you, Olga.
Okay, wonderful. Thank you very much. And with this, we are at the end of our session. So I would like to really thank you, everyone, for attending. It was a very interesting session. Particular thanks to all the presenters and discussants. And I would like to wish everyone a nice afternoon, the nice rest of the day, and a fruitful the rest of the conference today and tomorrow. Thank you and goodbye.
Thank you, Magda.
Thank you.
Bye. Thanks.
Really good. There was a lingering question, Martin, but it's fine.
Please, yes.
No, then the BIS, Bandari just left. No, the fact that there is also a sense of how you know, what is it that slow down? What is it in the debt of a firm that slow down investment and activity? No. So I was thinking of the spare tire. Not the first time talk about the spare tire thing, but if you look during the Great Recession, we had an enormous increase of corporate issuance by firms that basically accumulated cash.
Mm-hmm.
So there's this precautionary cash accumulation, right? So in a way, it's not clear. So those are technically far from zombie firm. So they have access to credit, but effectively they don't invest, right? So you just have all this cash because you know, the demand has become much more uncertain. So what I'm saying is that there are many ways in which the environment, apart from that, right, may push firms to do what they're not expected to do, which is to sit on cash or sit on debt and do nothing, right? At the end of the day, it's almost indistinguishable, right? So I wonder whether, apart from, so I wonder how some consideration of the specificity of the the global financial crisis, the Great Recession, can be taken into the econometrics. Because it changes a little bit, it changes the uncertainty and the incentive for firms to do or not to do things. Because at the end of the day, the zombie firm is always a little bit, the underlying idea is a deviation from the optimal debt structure, right? So you become a zombie when you're, I mean, to be a firm, you need that, right? We all write credit constraint model language. We claim that credit constraint are bad. So that is not per se bad, but it may become bad when there is a shot that sort of kill your optimal debt, your optimal financial structure. If you think a little bit more in general, you can still have debt and then, you know, swim on cash.
Right,
Making sure that at the end of the day, you have some kind of positive return, but you don't really contribute to anything there, right? That was a little bit the issue. There's a zombification at a higher level, right? This is the government issue legal liabilities. Everybody is happy to keep these legal liabilities, and nothing happens.
Yes. Yeah, this is. So I'm also very fascinated by these.
I just wonder whether you like.
What we tried is, or what we did is, we just excluded the most recent period, and results go through. So I think this is the best that we can do to make sure that these effects are.
I have no doubt that the results go through without the recent period. I just wonder whether there are ways, because the recent period is slightly different from.
Yes.
You know, basically, much of the resilience we were taking for granted is gone, right? We are now obsessed by large shocks. We are obsessed by tail risk, right? So I wonder. Again, also this term zombie firms, there is an issue of comparability. That's what I'm saying. There's an issue of comparability, or better, it's not an issue of comparability. It's an issue of understanding the zombification. What are the exact dimensions of zombification? Or there could be more. There may be more or less to it than we think.
Right. Yes.
Definitely fascinating. I mean, I was listening to your presentation. I'm glad because I always miss this paper, so finally I hear it.
Yeah, hopefully I delivered in some way.
Very clear.
Thank you very much. So I took notes and I tried to listen.
Like I don't know how to address it. It's just something that sort of bothers me, no? Because we run the risk of being too crude, no? In a world that has become extremely complicated.
Right. Yes.
Forcing firms to restructure everything. I don't know. Like at this stage, it's so complicated that it becomes.
Also, there's the talk of rising monopoly power. So kind of lack of investment and a pile of cash may also be a symptom of that, perhaps.
I just took it for granted, but that's exactly one of the other aspects of the the technology and market size dimension of what I was saying. Very good. Congratulations.
Thank you very much.
Ciao.
Thank you. Enjoy the rest of your day.
Yeah, same. Yeah.
Bye-bye.